Hi, this is Robert Weinberg, and on this channel, we help individuals to achieve freedom through expert mortgage and financial strategies. If you're new to the channel, go ahead and hit the subscribe button. Also, click the bell so you get notified on all of our future content. In today's lesson, I'm going to discuss the top 3 mistakes that I see homeowners make when refinancing their home. The first mistake is going to be choosing the wrong lender or the wrong company to handle your refinance. Now, I've talked about this in a lot of other videos, but it bears that I mention it here again. You really want to make sure you're dealing with a good, trusted advisor when it comes to your mortgage, because it's probably one of, if not the biggest transaction financially you're going to make during your life. A lot of people just get an offer in the mail or on their mortgage statement and they just go with that first lender. But you need to understand, first and foremost, the existing servicer of your mortgage will not necessarily be able to give you any better of a deal than another lender. And they also will not be able to make it a much easier process. Typically, they're going to have the same guidelines and the same standards as any other lender. So I have a lot of people make a big mistake by just talking to their current lender or servicer and not looking at other options. So that's the first thing. You also want to make sure that you don't just go off an advertisement, whether it's through the mail, an online ad, or a television advertisement that looks good, because again, that's just marketing. That's just a gimmick to get you to respond and become a lead. It doesn't necessarily mean you're going to get the deal that you saw, and it doesn't necessarily mean that that's a better deal than you could get elsewhere. As I mentioned, you want to make sure you're dealing with a trusted mortgage advisor that's got your best interest at heart. And I usually recommend that if you get an uneasy feeling or want to shop around, you talk to at least a couple lenders, at least 2 to 3, just to make sure that you're in the best situation for your needs when it comes to choosing a lender. Next thing is, I see a lot of people just going off trying to get the lowest interest rate and a specific loan program, but you may be selling yourself short, because a lot of the time the lowest interest rate is actually going to have the highest fees. And some of the major online lenders I see really taking advantage of people with this, where they'll tout this rate that looks like it's lower than the competition. But when you get down to the paperwork and the loan estimate, it shows that they're charging you 2, 3, or even more discount points in order to get that rate. So you as a homeowner look at, oh, I'm getting this, 3% or 3.5% or whatever the rate may be, and you're getting this good deal, but you need to look at what is it costing you in points and extra fees to get that rate. A lot of the time you'd be better off actually paying a higher rate and lower fees, just depending on how long you're going to stay in that home and how long you're going to keep that mortgage. So you want to make sure that you're going to look at multiple loan options. You want to look at an adjustable rate versus a fixed rate, maybe a 5-year adjustable versus a 10-year adjustable. You want to look at a 15, a 20-year, and a 30-year mortgage. And you also want to understand your prepayment strategy. So maybe you're going to take a 30-year mortgage and pay it off quicker, or maybe you're going to take a 15-year mortgage and pay it off quicker. You need to understand all these different parts of the process and how they actually go into your mortgage and your specific financial circumstance. So you want to make sure that you explore all these different options before you make a decision, and not just taking the first offer that's given to you. The last and final mistake that I see a lot of homeowners make is that when they're doing this mortgage transaction, they don't take enough cash out. So a lot of lenders will offer you a loan with some cash out included. Now, there is usually a bump to the interest rate when you take more than $2,000 in cash out. So my rule of thumb with most of my clients is, if you're getting less than $10,000 in cash out from your mortgage, most of the time, it doesn't make sense to actually take cash out of your mortgage because of that bump to the interest rate. So if you only need $2,000 to $5,000 or $7,000 in cash out, there's some other creative ways you can strategize with your mortgage advisor to get close to that amount or the amount that you need without actually taking a cash out refinance mortgage. And the main ways that I do this with my clients is, you're allowed to get up to $2,000 in cash out from a no cash out mortgage. They still allow you to get a couple thousand. So if you were trying to get cash out, but you only needed a few thousand, we could give you up to $2,000 directly from the mortgage. And then depending on how your advisor structures it, you would get between 1 and 2 months with no mortgage payment due. It would be a deferred payment that would be included in the payoff of your current loan and the interest on the new loan. So if your current mortgage payment is $2,000 a month, that could save you anywhere from $2,000 to $4,000 on this new loan. If you take that and add it in with the $2,000 at closing, that could give you $4,000 to $6,000 right there that you would get without actually borrowing that extra money and bumping the interest rate up on a cash out loan. And lastly is an escrow refund. If you have an escrow account with your current lender, then by law they're typically going to refund that to you within 30 days after closing. Depending on where you're at in the country and time of year, that escrow refund could be anywhere from $500 to $1,000 on the lower end, and I've seen it up to even $3,000 or $4,000 if you're in an area that has higher property taxes. So if you add that all together, you can see why you can get very close to $5,000 or $7,000 by not even borrowing that extra money directly from the mortgage and just creatively structuring it with your advisor. My typical rule of thumb, as I mentioned, is if you're going to be taking more than $10,000 in cash out, that's where it can really pay to take that cash out mortgage. And the other thing is you're changing needs. If you know you're going to need cash out, you are better off taking more than less, because the last thing you want to do is be in a position where 3 or 6 months down the road, you're kicking yourself saying, gosh, I wish I would have borrowed an extra $5,000 or $10,000. So make it count. And as the saying goes, try to kill two birds with one stone. If you see a future need for additional cash out, you're better off just handling it now than having to refinance again down the road. I hope this helps. I hope you learned something, and I hope that you'll share this and leave your comments below. Please follow me on all my social media channels, and if I can personally be of assistance to you or anyone you know that may want to implement these strategies and make sure that they don't make any of these major refinancing mistakes, please reach out to my office either via text or phone call. Talk to you soon.